Let's take a look at some introductory level questions for our chapter. And again, our chapter is based upon analyzing business transactions. So that's the topic of the day. So if we look right up here at the top, very interesting question here. It's a true false, and it says the increase side of an account is also the side of the normal balance. Okay? This is an absolutely true statement. Okay, so if we say that, for example, if we say that cash goes up with a debit, all right, cash goes up with a debit, so that would be, this up would be an increase, or we could say cash is increased with a debit, and then we would also say that cash equals a normal debit balance. Okay, same thing is true for accounts which have credit balances, such as liabilities, revenues, and so forth. Okay, and right on cue, which of the following types of accounts have a normal credit balance? Okay. Choice A says assets and liabilities. Well, liabilities is good, but assets, we just talked about assets. Those have a normal debit balance. What about B? Liabilities? Yes. And expenses? No. Because here's the thing, expenses increase as assets decrease. So let's think about this for a moment. If we have an asset which is decreasing, well, we would have increased that asset with a debit, so we would have to decrease assets with a credit. So therefore, because of that, expenses have a debit balance, not a credit balance. Choice C is going to end up being our answer. And I like this example because we can provide an example of why this is true with the cash account. Okay. Revenues have a normal credit balance. So let's think about a sales transaction for $50, and we're going to receive that cash up front. So we would have cash as our debit, and then we would have revenue as our credit. Cash left, credit right. See how cash is to the left here? Yeah. Okay. And then conversely, if we were investing in a business, move that out of the way. If we were investing in a business, the business would get cash, and then the opposite side of that would be common stock increases to represent owner investment in the company. So again, cash left, debit, common stock right, credit. All right, next question says, where are we at? Okay, in accordance with the debit and credit rules, which of the following is true? Debits increase assets. Well, that's an absolutely true statement. That's probably the answer. Let's see what else we have. Credits increase assets. Well, credits decrease assets. So that's wrong. Debits increase both assets and common stock. Well, they increase assets, but not common stock. So I think that first choice is going to end up being our answer. I know it's true. I just want to make sure there's nothing else. Credits increase both assets and liabilities. They only increase liabilities. So that's wrong. And in fact, A is our only correct answer. Next, it says a list of the accounts used by a business is called the what? A list of the accounts, okay, that's right here, is a chart of accounts. We could have called it a list of accounts, but instead we called it the chart of accounts. And just for review, we know that the chart of accounts is organized with balance sheet accounts first, starting with cash and cash equivalents, and works its way into Non-current assets, liabilities, both current and non-current, stockholders' equity accounts. Then the income statement accounts are next. Income statement, revenues being first, and then finally expenses being last on the chart of accounts. A little bit of review there. All right, let's slide this paper up just a bit. And the accounts in the ledger of Monroe Entertainment Company are listed below. All accounts have normal balances. And the question just says total assets are. So we need to know two things. The first thing is we need to be able to add. And I think you've got that. I think you can do that, especially if you've got access to a calculator. Let's see here. Where's that calculator? Bring that right there. The next thing that we're going to need is we're going to need to know which of these accounts are asset accounts, which are liability accounts, and then we're also going to have to know if any of these accounts happen to be either income statement accounts or equity accounts. So the first one we have here is accounts payable, $1,500. I hope that by now you know that anytime you see the word payable, you have a liability, not an asset. Accounts receivable is the next item. This is most definitely an asset related to sales on credit, and we're going to get a future benefit in the form of cash when we collect on that accounts receivable. So accounts receivable, we'll put a little check mark there. Prepaid insurance, what do you think? Well, we prepay for the insurance and then we get the future benefit of insurance coverage. So prepaid insurance is in fact an asset account. Put a check mark there. Cash is definitely an asset account. I think everybody would know that. So now we're up to $7,000. Dividends, what do you think? Dividends are a stockholder's equity account. Now, dividends are not on the balance sheet. They serve to lower retained earnings. So dividends, stockholder's equity account, not an asset account. Fees earned. Another way we could say this is revenue. And revenue, fees earned, is over on the income statement. Therefore, it cannot be an asset. Insurance expense. And while we're at it, wages expense. Anytime you see that, and it's not a prepaid expense of some type, any type of expense is going to be an income statement account. So let's go ahead and put an X by both of those at the same time. And let's see what else we have here. Okay. So we got that. Land of $3,000. Land is a non-current asset. So let's go ahead and put a check mark by that. And what happened to our calculator? Plus 3,000 equals 10,000. And then finally we have common stock. This is also a stockholder's equity account. So if we write all of these things out, our final answer ends up being $10,000. All right, so that is the end of this handout, and we'll get another video started shortly.